Hello and welcome to this weekly market recap for the week ending Wednesday, January 15th, 2025. I'm Tom Bowley, Chief Market Strategist here at EarningsBeats, and it is certainly a pleasure to be with all of you again to go over some crazy back and forth action that we've seen over the last week. We didn't finish the week very strong last week. Thursday and Friday, we saw the market going down. We got a little bit of a gap down on Monday morning, and then we rallied back Monday, Tuesday, Wednesday. And actually finished with some gains for the week. So it was good to see that. The December PPI was out on Tuesday morning. That showed that we were coming in, well, we did come in much lower than expected. The core PPI was expected to be at a rise of 0.2%. Instead, it was flat. And then this morning, on Wednesday, we got the December CPI report out. And that too was below expectations. Expectations looking for a rise of 0.3%. And instead, we had a rise of just 0.2%. So all the talk about the inflation, surging or spiking, and the fact that the Fed is going to have to give up their idea of rate cuts in 2025. At least for now, it looks like nothing more than a bunch of headlines to me, media outlets with their scary headlines. And instead, what we saw was inflation coming in below expectations and still potentially heading toward the Fed's target. So that kind of changed things as far as the dynamics go in the market. Personally, I'm not surprised. We talk about this all the time at EarningsBeats. Headlines that you see in social media or at various media outlets, it's not like the news we used to get from Walter Cronkite. It's a lot of opinions. People copy links and send it to others, make it sound like it's news. It's nothing more than opinions. And the charts were just not following what everyone was talking about. I mean, there was no money rotating into areas that would suggest that inflation was going to be a problem. And so I'm not surprised when we come out with these inflationary reports or inflation reports that show numbers actually below expectations. Anyhow, let's take a look at what happened last week. So I just point out again that the end of last week, Thursday and Friday, were weak, but we came back this week, had a really nice first half of this week. And another reminder again that in this show, I'm looking from last Wednesday's close to this Wednesday's close. So anyway, just keep that in mind. But looking back over this past week, transportation leading all 6 of these major indices are green. But transportation, we haven't seen transportation lead because throughout December and into early January, we saw transportation, mid caps, small caps, the Dow Jones, all lagging. Well, guess what? Over the last week, and especially with this inflation data coming in tame or tamer than expected, look at the top 4, transportation, mid cap, Dow Jones, Russell 2000. So the S&P 500 and the NASDAQ 100 both lagging on the week. Looking at the sectors for the past week, energy and materials. First of all, 8 of the 11 were up. But notice at the bottom, 2 of the sectors that were down for the week include communication services and technology. Now, on an up week, and those areas being down, that might be a little bit of a warning. However, we saw on Wednesday with the lower CPI, core CPI number coming in, these groups were actually on top. So I'm going to show you today's sector performance, and you'll see financial sector, consumer discretionary, technology, communication services, with 10 of the 11 groups up. 4 of our 5 aggressive areas were in the top 4 spots. The only one missing from the top spot or top 5 was industrials, which still had a pretty decent week, which had a pretty decent day, rising about 0.6%. But really want to just point out that the leaders were in the more aggressive areas. And if you look down below, the one group on Wednesday that finished negative was consumer staples, dropping about 0.33 or roughly 1/3 of 1%. So all in all, I thought the action was pretty good. But let's go ahead and do a quick summary of what was going on just today, because I thought today was a big day, given, again, the fact that the CPI, the core CPI, which I think is one of the most heavily watched inflation data points that the Fed uses, And what we saw today was not really any kind of significant inflation. In fact, the annual rate of core inflation went down again, or went down because it has been kind of holding steady, trying to move back to the upside. It's been a little bit stubborn, like the Fed's talked about. That actually came down today. So I think that was all a relief to the market. And take a look at what we saw today. Dow Jones Industrial Average gaining 703 points. That was almost 1.7%. S&P 500 up 1.8%. NASDAQ 2.45%, the NASDAQ 100 2.3, small caps up 1.6, mid caps 1.3. And the only thing really down as you look at this was the VIX volatility index, which remember just a couple of days ago, 2150, now 1612. Just like that, more than 5 points on the VIX lower, which was more than 20 or almost 25% in terms of a drop in the VIX here just over the last couple of days. And that tells me that with this inflation data coming out, we're seeing a lot of fear come out of the market. And when that happens, normally is a great thing for stocks. And that's exactly what we saw. Some of the leaders today, and I'm going to pull up a few of these charts later in the show, but Tesla, the best performer today in the S&P 500, gaining over 8%. The auto group was the #1 industry group as a result of the strength in Tesla. Intuitive Surgical, third on the list, ISRG, they came out with preliminary numbers that were ahead of expectations. So big jump there in ISRG. That was a beautiful breakout today. This is a stock that is on one of our key portfolios at EarningsBeats. So that's going to obviously give us a really nice boost in our portfolios. And then you'll see a number of bank stocks in here. Bank of New York, BK, Wells Fargo, Citigroup, and then one of the top investment services companies, which is Goldman Sachs. This is the #1 weighted stock in the Dow Jones, Goldman Sachs. And Goldman Sachs, you can see up 6%. All these companies, mostly dealing with earnings, rising. So again, everything that folks were worried about, talking about inflation, completely wiped out with somewhat benign inflation data and also very strong earnings. And what have I always said about the combination of strong earnings and low inflation? That is nirvana for stocks. So, and that's the kind of reaction we got today. So I fully expect that we're going to see the recent lows holding as support as we go forward. If not, we'll need to be looking at what's going on underneath the surface of the market to make sure some of the key areas aren't falling apart. But otherwise, I really believe we're going to see the market either holding kind of in this consolidation pattern for a little bit or starting to move back to the upside. All right, let's look at some of the major index charts. So we've got the Dow Jones Industrial Average. Look at this downtrend that was in play. Last 3 days, beautiful action, back above the 20-day moving average, 3 straight days of just solid performance there. Look at that crossover on the PPO over the trigger line. So we're starting to see more momentum building now from underneath the zero line. We want to get that back in positive territory, but this is the first step, crossing back through that trigger line. So really, industrials have made a pretty good stand at recent support, which you can see we had a double top here up near 41.5. We had a recent low around 41.7. That was back at the beginning of November. And we went down and held support just above those 3 areas as you look at the recent highs and that recent low in November. So good action here on the Dow Jones. S&P 500, still got to get through this trend line, but we did finish back above the 20-day, which is a start. Getting through the 50-day would be nice. But if you look at this, we've been struggling with these moving averages. We go below, then we go back up above, we go below, we go back up above. And then the last time we came back down, it looked like we were breaking the neckline. And what I talked about then was watch gap support, because this thing is set up so that we could get a breakdown on the neckline, which could lead to some selling. But we also might see a little head fake to the downside with a move back to the upside. And so far, with the Tame inflation data, that's exactly what we saw here. NASDAQ 100 also moving back up through its moving averages, but like the S&P 500, We've seen a lot of this back and forth action. So moving averages don't mean as much to me when we keep going below and above, below and above. All of a sudden, they're not really providing us support. So in the short term, when you're in a trendless market like this, I think we can kind of throw the moving averages out. Instead, let's look at the recent low. Let's look at the recent high. That is our range of consolidation for now. So we either break below these lows that we've had recently, or we move back up and break out to all-time highs. That's at this point what I'm looking for. The IWM, the small cap ETF, nice gap up above the 20-day moving average. As I was telling members at EarningsBeats, you can see this 226 area has been a real key pivot for a number of months. You can see the tops up here around 225 to 227. You can see another one right in that range in mid-October. Then we gapped up above that in early November after the election, went back down. Where did we go to? Right in the middle of this 225 to 227 area. Then in mid-December, when we got the big breakdown after the Fed meeting, where did that breakdown occur? 226. Then we come back up beginning of December. Where did actually, and also, or latter part of December, and then early January, I should say, we had two different trips up here. Where did we fail? 225 to 227. Today, what was the high? 225.57. So clearly, 226, 227, this area right in here, we still need to get through on the IWM. If we get through, I think that's a really good signal. But we failed to get through. We pulled back. We closed below the open, but we did manage to hold on to the 20-day moving average at the close. So in the very near term, I'm kind of watching to see if we get the breakout or if we break back below that 20-day moving average. But ultimately, just like the other indices, I think the key support area from a more intermediate term perspective on the IWM is at that 214 area. Lastly, before we get to a quick little break over at EarningsBeats, I want to show you the 10-year Treasury yield, because this has been a problem for the market. Yields have been moving up. Everybody's saying, hey, it's inflation, it's inflation. I think it has more to do with the economy than it does with inflation. Because again, money is not rotating into areas we would have expected if inflation's a big problem. So that move down in the TNX today was a welcome relief for a lot of folks, especially areas like home builders, which now over the last 2 or 3 days, really starting to make a pretty good push to the upside. All right. If you go over to earningsbeats.com, I just want to point out, if you all haven't downloaded this free report, please do it. We're giving it away for free. This is a lot of research that I've gone back over the last 20 years putting together. This is an absolutely huge part of trading that you need to be aware of. If you click on that link, it'll take you to this page right here. And just to give you an example, some of the things that we look at and that you need to be aware of, this will show you how the S&P 500 performs on average every calendar day throughout the month, from the 1st to the 31st. This includes data going all the way back to 1950. So it's really important to understand how this works and how the market works. Why go away in May? I write about this every time we're about ready to turn the calendar from April to May, that you really need to understand the seasonal trends, and go away in May is just a myth. I mean, there is some significance to it, but you need to know a lot more information than what the media simply tries to sell you when we go into May. And then this might be the biggest one of all. If you don't know the 12 consecutive calendar days of every month that have produced over 80% of the market's gains, 80% of the S&P 500's gains since 1950 have come as a result of the trading of 12 consecutive days, the same 12 days of every month. If you don't know what those 12 days are, this will be probably a godsend for you in terms of trading. Don't you think it would be helpful to know when most of the gains are made throughout the calendar month? Seems like that would be something that a trader, swing trader, day trader, whatever, would certainly want to know. So make sure you go over there. In our video in the description, there will be a link where you can check that out. But please If you haven't signed up for this, my goodness, this is a lot of research, a lot of work that we've done, and we're simply giving it out to our community so that you have some of the same information that Wall Street has and get a better idea of when they buy and when they sell. All right, moving on. So I wanted to go through some of these charts that were really important today in particular. So here's the Tesla chart. I see a break of maybe this little down channel to the upside over these last couple of days. I think that we have a really good chance on Tesla to make a run here, maybe back up to around 460. That would be the first key area of resistance. And then ultimately getting back up close to 480, where we saw that high in mid-December. Next up, Intuitive Surgical. This is that chart I wanted to show you, this breakout. Look at that volume coming in after sideways consolidation, another breakout on ISRG. And it came right as we got that PPO center line test. And if you look back in mid-October, we had a breakout from sideways consolidation right at that midpoint, that center point zero line. That's exactly where momentum kind of shifts, and there's really no momentum at all at that point when you're at the zero line. And so we don't really know which way the market's going to go, or in this case, where the stock's going to go. Well, we got that positive fundamental news, and ISRG now is set perhaps to go much higher from here. Next up, how about JP Morgan? I mean, the number that they came out with on their earnings per share, they beat estimates by 19% on their earnings. Yep, just a stodgy old bank. They beat by 19%. And what happened? We closed at an all-time high on JP Morgan, breaking out from this sideways consolidation. That's news worth knowing. Citigroup, big breakout, had a nice little uptrend, little cup, handle back to the 20-day. Well, there's your breakout, and there's the volume down here to confirm it. Another great report. All the reports I looked at of the significant companies today were exceptional. Earnings, the economy's been resilient, and I think we're going to see a really strong earnings season here as we go throughout the next several weeks. And whether or not we get breakouts or not, well, that all remains to be seen. But I think these reports are going to be strong. Next up, Goldman Sachs. So there's the big move on Goldman Sachs, 6% today, threatening the high from back in early December. Just in the last 3 days, we've gone from below 560 to above 600, going from recent price lows, recent support, all the way back up to test key overhead resistance. A breakout above about 610 or so would be really bullish on Goldman Sachs, so keep an eye on that. And then XLF ETF got a big breakout here, taking out the recent high. I think this news about the lower inflation, lower than expected, I think this really helps the financial stocks. Industrials starting to make a move back to the upside, still have to negotiate that 50-day moving average, but at least the last few days moving in the right direction. Technology, nice move the last couple of days, but we still got to get back through these moving averages. We don't want to fail there. We want to make it look like we're sideways consolidating at least, and that means we do not want to fail at the moving averages and move to a new low. We want to get back through those moving averages, so keep an eye on that on the XLK. XLY looks to me like a really nice breakout of a wedge, a bullish wedge. So right there you can see very strong. And then if we connect the lows, connect the highs, you see that squeezing piece of pie? After an uptrend, that's what's called a wedge, a bullish wedge, where we expect to see the breakout. In my opinion, we just got that today with the XLY. So that was a positive development today as well, getting back through the moving averages. And then I think the last one we had here is the XLC, which is up against moving averages and also the downtrend line. So we're either showing some great action and looking like we're going to move back toward the highs in areas like the financials and in consumer discretionary, and with others like technology, communication services, we're getting closer to key levels. Still need to show a little bit more to the upside to get these breakouts. But all in all, I mean, I think the market has recovered really nicely. And who knew it? Who thunk it? Inflation lower than expected. I'm telling you, stop listening to the media. I wanted to show you internet. We're going to end with this one right here. So internet stocks, I thought this was a cup and handle, but it's looking more like an ascending triangle to me off of this uptrend. Equal highs coming across, rising lows, a breakout above about 52.25 or so would be really bullish for this group. And in addition to the charts being bullish and setting up for possible breakout, let's not forget seasonality and internet stocks relative to the S&P 500. I want to show you as you look down here at the average return, average relative return for each of these calendar months over the last 20 years. Internet stocks love the first calendar month of each quarter: January, April, July, and October. If you add up the average outperformance in those 4 months, that's 1.5. Add in April, that's 2.3. July is 3.4. October, 6.3%. 6.3% average outperformance over the S&P 500 during the four initial months of each calendar quarter. Again, January, April, July, and October. And that goes back 20 years. Look at the second month. February down a half, then May, so that's up 1 in total. August 0, so that's still up 1. And then November minus 1.6. No, the second month of calendar quarters is actually negative 0.6%. And then the third month is actually a little bit better, but still nowhere near the first month. But March minus 0.5, June minus 0.1, so that's minus 0.6. September takes us back to 0.5 positive, and then December add on 9/10, and we get up to 1.4%. So it's 6.3 minus 0.6 and plus 1.4. Clearly, over the last 20 years, the first month of each quarter, this is when internet does its thing. And again, just looking at that chart, I just want to point out we're in a bullish pattern. Already in January, you can see that the internet stocks have gone up about 4%. I believe the S&P 500 right now is up about a half of 1%, or maybe 1% for the month of January. So we're already showing internet 4 times as strong as the S&P 500. If we get this breakout, I think this is a group that could definitely be a leader for us over the next couple of weeks. So keep an eye on internet stocks, and just keep an eye really on the market now that we've got these lower inflation readings. It seems to me like the market is trying to set up maybe to move higher here over the short term. But getting through some key moving averages that I showed you will be important. All right, that's it. For those of you who would like to follow me or follow EarningsBeats, there's a slide on your screen. You can simply scan that QR code, and that'll take you to a page where you can find out where we are on YouTube and where we, the articles I write at Stockcharts, the shows that I'm doing, and so forth. So make sure you check that out. But that's it for this week. So I'm really looking forward to what the market has in store now that we maybe can put the inflation news and inflation story to a rest. At least, give us a couple weeks before you're going to bring up all this media hype again. And I don't mean you personally. I'm just talking about the overall media outlets that are out there. The news I'm seeing is, in the charts. What I'm seeing in the charts paints a whole different picture than what the media is trying to paint for us. Anyway, have a great rest of your week and weekend, and I'll be back next week to do it all over again. Have a great day, everybody, and happy trading.